Hello and welcome to another episode of the Investing with IBD Podcast. It's Justin Nielsen here, your host, and we are coming to you live at 5 p.m. Eastern as we do every Wednesday. So hopefully if you can't join us live, you're still viewing us or listening to us on your platform of choice. We are on Spotify, Apple, you name it, we're there. And of course, we go live on YouTube every week. Today is July 23rd, 2025. It's the birthday of one of my close neighbors growing up. And we also have a great show lined up for you. We're bringing back one of the market wizards that was interviewed by Jack Schwager a number of years ago, Jason Shapiro of the Crowded Market Report. He's been on the show before, and one of the great things about Jason is he's got this contrarian attitude that really works for helping smooth out the portfolios for a lot of his clients and makes some decent money at the turn. So welcome back, Jason.
Thanks. Good to see you.
Good to see you as well. So I'm gonna start right out of the gate with a chart because one of the important things for people to realize, and maybe you can talk a little bit more about this, is this whole idea of what everyone else is doing. That's not where you like to be. So talk a little bit about how you kind of came up with that and why it works so well.
I mean, it was a process that was developed over a bunch of years, but the obvious answer is I watched myself doing things and losing money. And thinking, well, gee, if I just did the opposite of everything that I did, then I would actually be making good money. And then I watch other people doing the same thing, and then it's like, well, if that's the case, then why can't I try and figure out when we're all doing the same thing? That probably increases the odds at doing the opposite of that would work. It kind of started with that type of attitude and then just really grew from there through basic contrarian thought processes and basic sort of financial theory processes.
And a little bit of trial and error, I'm sure. So what I'm going to do is I'm going to share a screen real quick. And let's see, I just need to get back to the right area. So I'm going to share our presentation here, and this is the NASDAQ futures, and this is what you give your subscribers at the Crowded Market Report. You give a whole host of charts that look exactly like this on all sorts of different futures markets, and this, I guess, is the objective way for you to tell when things get crowded. So walk us through a little bit, because certainly the things that jump out are these big blue areas and these big red areas. Who do you follow here?
Right. So this is the chart of the commitments of traders data that comes out every week, which is released for every futures market. And make no mistake, you can get these commitments of traders charts on the internet all over the place. But the one we're showed here is the one that we actually put together because I didn't find any of the online stuff to be very good. And so we put these together. I was previously actually buying COT charts from someplace that was a little bit better than I could see on the internet, but my partner ended up making our own because they're just that much better and they're that much more interactive, and you can change the dates and you can do a whole bunch of different adjustments and all kinds of things to them. So this is what that shows. So there are three groups of traders that are released. One of the commercial traders, which is the red. A commercial trader is somebody who has a commercial interest. If you're a grain farmer, you're a commercial in the wheat market, for example, right? Anyone who is not a commercial, and the reason that people choose to be a commercial trader is because they get less margin requirement because they have the underlying thing. So therefore, they fill out a futures account opening form and they check off commercial if they are in fact able to do that. There's benefits to it with margin. Everybody else falls into a speculator. The blue is the large speculators. The yellow is the small speculators. It's also called reportables and non-reportables. If you have a certain amount of contracts on, you are reportable, which means you have to report that. They're trying to stop people from getting too big and cornering a market. So you show up in the blue if you are a larger player, and everybody else just falls into the yellow, which is the small speculators, which would be most of us. So that's what that shows. What I find is at market turns, which is what I use this for, and there's a number of ways you can use this. but I use it for market turns. Very often at market turns, these speculators are very one-sided on the market, and therefore the commercials are very one-sided the other way. So here we're seeing speculators, the blue, large speculators getting very long here, and the commercials therefore getting very short. That's what this is showing here.
And so you want to be more on the side of the commercials because they're the ones that
At the
what they're doing
extremes.
more, or you just want to be against the speculators who
Well,
tend
it's
to be wrong.
one is the other. So,
Right, exactly.
but at the extremes, because that's what works sort of a lot of times at market turn. The market doesn't always turn when this is the case, and when this is the case, the market doesn't always turn, right?
Yeah.
But I find that a lot of times when this is the case, with some other filters involved, you can catch a market turn, and what that gives you is a very good risk reward trade, essentially, right? Which is what I'm always looking for, right? I have found that my ability to predict markets or predict the future is not very good. So I can't count on that to make money. But what I can do is try to get into situations where the risk reward is in my favor, so that if I'm wrong, I can lose $1, and if I'm right, I can make $4, $5, $6, $7, right? And over time, if I can do that, that's what's going to produce positive returns for me. So when we see this very one-sided action, doesn't mean the market's going to turn, but it means if the market does start to turn, there can be a very big move, because all of a sudden you have these speculators all lined up on one side, and the market turns, and all of a sudden they all have to get stopped out and reverse their position and go the other way. And so because they're so loaded on one side, that can cause a big move the other way.
Yeah, makes sense. And so just one more line to kind of identify here. You've got the green line, which is the sum of open interest. Is that something that's important, or is it just kind of there for information?
It's just there for information.
Okay, to like let you know about the liquidity. Of course, the Nasdaq future is very liquid, not really something you need to worry about. But is this for maybe some other markets where you just want to know that there's liquidity there?
Some people like to use the open interest information as well as just the net positioning in the futures markets. I personally have not found that to be a help through my testing, so I do not use it.
Okay, so let's talk a little bit about how this might be used, because I'm looking at the blue area, and certainly what jumps out at me here is that there was a lot of blue on the long side in January and February, and a lot of red. So that's the commercials on the other side of that trade, short, in that January and February, and that actually coincided with the top of the market. I mean, that was, we had DeepSeek in there, of course, on January 27th. We had the top of the market in February of 2025, just a few short months ago. So was there any indication off of this that, oh, okay, people are getting a little bit too excited with this market?
Yeah, I mean, you can see it. There was the indication, right? You can see how long the blues were and how short the reds were, right? So that was the indication that they were getting too crowded there.
And for you, at least, my understanding is it's not just about this chart. That kind of lets you know when you're in the right environment, but you need kind of that trigger, that tells you, oh, okay, now it's time to do the trade. And you call that the news failure event, as I think the prime one that I associate with you. Can you talk a little bit about that, what the news failure event means, and specifically how you discover it, how you find out, oh yes, this qualifies?
Right. So, like I say, if this commitments of trader data was great and perfect and beautiful, that's all we would need. But just like any piece of data, that's not the case, right? This gives an indication, okay, people maybe are too long here. But that doesn't mean I'm going to short it. People can stay long, get longer, you know what I mean? All kinds of things can happen, right? So I need the market to confirm the idea first, which I think no matter how you're trading, is a very important concept, right? Let the market confirm what you believe before you do anything, right? The market is the ultimate answer, right, in what we're doing. So for me, okay, everybody gets too long. I'm looking to get short. That's all I'm looking to do, is get short. But I don't get short until the market confirms that. So what does confirm mean? For me, what it means is I'm now following. If everybody's super long, I'm following. Well, why is everybody super long? What's getting them so bullish? What's the narrative behind that? And I'm looking for news to come out that supports that narrative. So here's why everyone's bullish. Here's why everyone's long. Here's a piece of news that supports that. The market should go up on that. And it doesn't.
Mm-hmm.
The market probably goes up on the news, and by the end of the day, it closes down on the day.
Right.
Well, that's the market saying to me, okay, it's done. Right? Now is the time to short. Everybody's too long. It cannot react well to positive news anymore. So I get short there.
Mm-hmm.
And obviously the opposite for when I'm getting long something.
Right. So this is the NASDAQ. I'm just going to pull up a price chart. So again, this is where that area in January and February, where there were a lot of longs in the speculative area, a lot of shorts in the commercial. Was there any confirmation, I guess, when
If there was, I missed it.
Yeah.
I never got short. So yeah.
and you know what? I think this is also an important lesson is that this isn't you don't always get both, right? Sometimes you'll get one and you won't get the other. If you don't get that confirmation, you're maybe not acting on anything, and sometimes you don't get the confirmation, and so you don't do anything. I will just.
I mean, there's a discretionary read to the confirmation as well.
Mm-hmm.
So I could have just read it wrong as well. I don't know. I think that one of the important things about this stuff is while I personally may have missed a short and other people may have missed a short, this would have at the very least, if you were a trend follower,
Mm-hmm.
it could have indicated to you that maybe now is not the time to be heavily involved in this trend because
Yeah.
too many people are involved in it. So the risk is that if something were to go bad, a whole hell of a lot of people have to get out and you could have a pretty big move the other way, which is what happened obviously in this case. But you know, it helps with that as well. Like I counter trend using this stuff, but you can also use this stuff very, very well for trend following type of stuff too.
Mm-hmm.
It keeps you out of a lot of trouble. I like to say that the COT is not necessarily a great market predictor, but it can be a great risk manager.
Yeah, right. At least let you know when to not put your foot on the gas and get super aggressive. Even if you're taking your foot off the gas, that can really save you quite a bit of money. I did just change my chart to January of 2023 because you were on the show previously, and this was just a really good example of what that news failure event looked like, where you had a situation where, if I remember correctly, you know, as you were telling me the story, you had like the worst CPI number ever. You know, it was like, or not ever, but it was just a horrible CPI number. And what happened to the market? It of course, you know, plunged early in the session, but then by the end of the day, it was up considerably. And you know, that in combination with your COT, your commitment of traders, telling you they were on one side, super short, the speculator super short, and then you got that news failure event, an unexpected direction, and that was the bottom of the market right there.
That's correct. You know, the market was coming down all of 2022.
Yeah.
Because of too much inflation. That was the main narrative behind it. The Fed was raising rates pretty aggressively because inflation was too high. And on that particular day, we had the inflation number come out the highest print of the year.
Mm-hmm.
So again, confirmed the fact that the market should go down. It gave all the bears why they were bearish. It gave them all the reason to stay short or get even shorter. And by the end of the day, we closed up that day. And that was the exact bottom of the market ever since.
Mm-hmm. And I feel like this is where the risk management really can kind of help because, okay, if you saw that, oh, people are getting too short up here, there are too many people are on the right, you know, the same side of the boat. Yeah, you might have said, oh, well, I'm gonna get involved on any of these days, but this was the day where you could manage your risk a little bit better. This is where you had the news failure event. So again, that combination. Going back to the current, talk a little bit about what was happening during this whole period. Now, I personally was just like, this volatility and everything that was going on with the tariffs, it was too much for me. I'm like, there's just no way I want to participate in this. But you found an opportunity to kind of go with this turn that happened. What was the news failure event that you kind of gravitated towards on April 7th?
So again, we know that what was going on in April was the whole tariff situation, right? That was
Right.
what was driving everything. And on the day Monday of the low,
Mm-hmm.
we had news over the weekend that was also very bearish tariff news. They were all going crazy about it, and the market gapped down. Everybody was sort of looking for a crash on that Monday morning. All weekend, everyone thought there was going to be a crash,
Mm-hmm.
and the market opened down and finished the day up at a time when there was some very large short open interest on the COT. I personally bought Dow. That's where things were most short on the COT. So that's what I bought, but that's just the way that I do it. I go with the one where I see the speculators are the most short and the Dow is it. So
Mm-hmm.
there it was. They were super short. You got your news failure event. You buy it and and you try to ride it until this data goes kind of neutral.
Right. Now, this didn't seem nearly as, I guess, and I'm showing right now the Dow Jones futures, the April 7th news failure event. It certainly doesn't seem like those bars on the commitment of traders were as dramatically one way or the other as they were before. So,
So what we have to do with this stuff, or what I do with this stuff, is you have to index it, right, to history, right? Because some of them, for example, like gold, you
mhm,
never see commercials getting net long gold or speculators therefore getting net short, right? Because commercials in gold or miners are always selling future production, right? So
mhm,
you have to index it relative to history. So
mhm,
if you look at that red bar, it doesn't look like it's so much up there,
mhm,
but if you look at it to the history, it's the most that it had been over the course of my look back period, which is about a year, right?
mhm.
So therefore, my index will show, it indexes it from 0 to 100. So my index would show there that it was 100, meaning that that's the longest they've been over the last year. And when that index is set up and I get the news failure, then that's when I go with it.
Yeah, no, totally makes sense. And I think the thing that also, again, I was personally too scared myself because I was just waiting for, some other piece of news. It just seemed like there was so much happening at the time. But you did have a situation where, okay, you had a reversal. Um, you knew where you could put your stop, and so to your point earlier, you have your risk set. Now it's just a matter of how do you kind of determine how high can this go? When you're trying to put that risk reward in your favor, do you have any like, oh, my risk amount is this much. This could be 3x that, or
Yeah, I never know. I never
mhm,
know. That's not something I can know in advance or something that I can control for that matter. What I
yeah,
do is, okay, so my index says, okay, the commercials are super long. There's a news fair, I buy it.
hmm,
My stop is on the low of that day. I'm a turn picker. So clearly, if it goes through the low of that day, then I didn't get the turn, right?
hmm, yeah, right,
It's a new low, so I didn't get the turn. So I get stopped out there. So I
hmm,
know that my stop is that low. I know where my entry is. So I know how much I'm risking per trade.
yeah, no, makes sense.
And from
Um,
there, if it works, I just sit on it until my index goes neutral. If the edge is I'm long because everybody's short, well, when everybody's not short anymore, then my edge is gone, so I'm out. So
mhm,
you can see where my exit was there. You can see where the speculators, and again, it looks like they got super long, but based on the history and the look back, that is where they went neutral. So when
mhm,
they got neutral there, that's when I get out. And, it ended up to be a pretty good trade. I don't know if it was like
yeah.
3 to 1 or
So
something like that.
So for those that might be listening to this, that news failure event, of course, was at the bottom day, April 7th, and again, Jason chose the Dow Jones futures as his trade, and the exit was on May 30th. That's when the neutral, kind of came in, and at that point, you had made quite a bit. And to be fair, I mean May 30th, that was kind of a time where the markets were going sideways for a little bit. There was a little bit of that letting off of the steam, as it were. I want to shift gears and kind of go into some of the other trade examples that you have because While this is a market one, and again, I think most of us that work at Investors Business Daily and maybe listen to this podcast are probably a little bit more comfortable with the market indexes. You do this on any futures contract. Again, they all have that commitment of traders from the commodity board. So you can do this with any futures contract. So here is an example with the British pound. Can you walk us through your trade here?
Yep. So same type of thing. This was all people. It's funny because now people are so bearish dollar, but you forget that back in the beginning of the year, people were very, very bullish the U.S. dollar, right? We were talking about U.S. exceptionalism. There were cover stories on The Economist about the U.S. dollar, taking over the world. Well, it already has taken over the world, but everyone was very bullish dollar back then. And we see that on the red thing, the commercials, that's the longest they had been in a long time. So my look back showed me as a buy. On that particular day, there was some bearish news. There was some bullish U.S. dollar news. And the pound closed up on that day, I believe, while all other currencies closed down. So there was no reason for the pound to be up that day. Everybody was super short. So I get long pound that day versus the low of that day. And I ride it until my index goes neutral, which was over there. And I don't know what this was, a 4-to-1 trade, maybe 4-to-1 risk to reward or something like that. So 4 or 5-to-1, something around there. So again, that's what I'm trying to do. If I can make 4 or 5 times my risk, over time, then it allows me to have 40% winning trades, which is about what I have, and still put up very nice returns.
Right. And okay, you got out here. So again, your entry was on January 21st with the news failure event. Something that should have sent the pound lower because of the strength of the dollar didn't. You got out when you got a little neutral here, a lot more longs for the speculators. So it's kind of like when they finally figured it out and were joining you, you're like, okay, now I don't want any part of it anymore.
I mean, especially when they get squeezed out of their shorts, then I no longer want to be long. I mean, this is no different in a way to what people are doing with these meme stocks now, right?
Yeah.
They're looking for massive short interest in stocks, and they're buying it and trying to squeeze out the shorts. That's what the original one was. What was it? The GameStop thing, right? It was all about that people were way too short it and they squeezed them, right?
Yeah.
It's the same type of thing, Right.
And look, this wasn't the top. I mean,
No.
the pound came in a little bit, so it wasn't a bad trade. It was a near term, very close to a near term top. But then it started moving again, but there really wasn't that lopsidedness this time. So do you ever find yourself getting back into something because it's moving again?
No.
But if it's not lopsided, you just don't.
My edge is my edge, you know what I mean? From when they're super short to when they're neutral, that's where I play. That's where I find my edges. Once they go neutral, I mean, what's the market going to do? It's either going to go up or down.
Right.
But it's just not where I play. It's more of that's where the trend followers now play, right? But that's not my game. I pick the turn. I try to catch, 4 to 5 to 1, and then I'm out, and everybody else can go have fun.
Now, do you ever look at your that 3-to-1 or 4-to-1? I've made this much profit. Here's how much I was risking. I've made this much profit. If you don't see that neutral reading on the COT, do you still say, oh, maybe I should just trim a little bit into the strength, or do you kind of wait for that neutrality?
I say that all the time, but I don't do it.
Okay.
Because doing this does a lot better job over time than I do. So, and it's funny because you look at this trade here. This was the yen. Okay, you can see how long the blue guys got the yen at that point. There was a news failure there. I got short, and within a very short period of time, it was a very good trade. It was like a 7-to-1. It was 7-to-1 because the day of the news failure was a very small vol day. So therefore, I was able to get a lot of size in since it's a function of my entry and the stop, right? So
And
that
that
was
day
like,
was April 30th. Do you recall what the news was
I
on
don't
that day?
remember exactly. To tell you the
Okay,
truth.
yeah.
But that was within a very short time. That was a very good trade. And then look how much of it gave, almost all of it back, right?
Hmm.
As time went on and just kind of hovered around. And then, okay, gave me my exit, which was actually just last Friday.
Hmm.
And I ended up making a little bit more than I would have if I had taken this off, 10 days later. But that's this one trade. These all look different. The path of what happens a lot of times, it's different all the time, right? Sometimes I get these trades and they go straight in my favor and I make a bunch of money in 3 or 4 weeks and I'm out.
Hmm.
Sometimes it takes time and look, sometimes it goes in my favor and eventually ends up stopping me out, which always is horrible.
Hmm.
But again, over time, both back testing and now 25 years of actual trading
Hmm.
have shown me that over time, this is what gives me my best risk reward returns and my best risk adjusted return stream.
Right.
But I
Now,
mean, this ended up being like a 6 or 7 to 1 return to risk or something. So, was a good
oh, it looks
trade.
like your note there has a 12 to 1.
Oh, was it? Okay.
Yeah, so
Yes, I
even
mean, it doesn't take a lot of those,
yeah.
It
Well,
takes 4 or 5 of these trades a year, right?
so
If I make 5 trades a year that average 5 to 1, that's 25% on the year, right?
mhm,
If I'm risking 1%, that's 25%. And let's
mhm,
say that I have a bunch of other trades that lose. Okay, so that's really what I'm shooting for me, right?
yeah.
Without drawing down 5%. If I can make 15 to 17 to 18% a year with a maximum drawdown of 5%, I think you'd be very hard pressed to find anything that makes a return of 3 to 4 times the drawdown. It's very,
Right.
very,
No,
very,
no,
very,
absolutely.
very hard to find that. And that's what this has helped me do over 25 years. So,
Hmm. So I'm trying to understand a little bit, and this is something that I think will help our listeners as the position size here, because you say you really only have to get, you know, 5 of these trades right, and you're pretty much good for the year. So, what does that position size look like for you?
so, for me, I risk 70 basis points per trade.
Okay,
So, like I say, I
that's
know
70
my,
basis points of your portfolio
correct,
value. Okay.
correct.
Hmm.
So I know, like I say, my entry and I know where my stop is. So therefore I size the position so that
Hmm.
if I get stopped, I'm going to lose 70 basis points. Well, and of course, there's always a little bit of slippage, but somewhere close to 70 basis points if I get stopped on the trade. That's how I size.
Hmm.
Some people are more aggressive. I don't like to. That sizing is what has shown me to get me to a portfolio volatility that I am comfortable with, which is like a max drawdown of 5%.
Right.
Some people are like, well, why don't you lever it up and draw down 30%? Instead of making, 15% a year, you can make 6 times that.
Hmm.
That's just not me, you know.
You decided against the ulcer. So,
My age has provided me, yeah, with deciding against the ulcer, and also, the money that I manage is mostly institutional money,
uh-huh.
and they're not looking for those kind of returns. They're 15, 18% a year. You know what I mean? Is
They're happy.
with negative correlation to the other things in their portfolio, and this offers them a great thing to put in their portfolio.
Hmm.
And they,
And
of course, have the choice to lever it up if that's what they want to do.
right. And it's also this is an important point that I think sometimes is easy to miss is the fact that you are looking at all of these do put it in a negative correlation, so that for these institutions you're very attractive in that regard, right? Being able to provide that negative correlation and a decent risk return. So this is something that growth investors might think of for themselves, because again, sometimes that you will be in phase with what a growth investor might be doing, like what you were doing with the Dow Jones trade. That was, perfectly in line with, a rally is starting, growth, really came on strong. But other times, you're involved with all these different markets. You can get something out of them that maybe you don't have growth working, you don't have stocks working. It's something completely negatively correlated with your normal stock.
I
So
mean, I can tell you over time, as you start to look at the positioning, as I do, of all these different markets, the matrix suddenly becomes a lot clearer. You know, you're looking at stocks, bonds, currencies, commodities, and all of a sudden it's like, okay, all these things are lining up and everything is pointing towards this, you know. And this is kind of what I do in my newsletter every week is I try to put them all together and put what I see
Yeah.
as the conclusion to this whole sort of matrix thing. But it can help in many, many ways. You know, you can say, yeah, as a growth investor, you know, you're looking to buy the stocks, but I mean, this would have kept you away from buying the stocks until really second week of April.
Yeah. Which again,
And you could have bought them with a lot more confidence
yeah.
knowing this information.
So let's switch gears a little bit and kind of go back to our initial chart on the Nasdaq. Maybe you could kind of tell us where we're at right now. I mean, this seems like the blue bars, the large speculators, are getting more in line with where they were back in January. So the commercials, at least on the Nasdaq futures, seem to be getting closer to that extreme level that they were back in January. So is this giving you a cause for concern?
It is. I think that the big question for us at this point is, has this AI thing been discounted into the market, right? We all know about the AI thing at this point. We all know the numbers are huge. We all know the investments are huge. We all know it's not going anywhere, right? Where it's going, we don't know, but we know it's going somewhere.
Yeah.
You know? We may not know what
Speed
that
and who, that's the mystery, right?
Right.
But we know something's happening.
Right. What the world's going to look like, we don't know. Everyone has their opinions, and there are many opinions. But we know something's going on. We know a lot of money is being invested in it. So we know that's kind of what's driving everything here, right? So when is that discounted in? This would indicate that it is pretty far discounted in at this point. Because people are clearly have gotten very long the NASDAQ stuff. Whereas if you flip, this is really interesting, if you flip to the Russell chart, it's the exact opposite. And this is sort of the AI thing too, right? People have become of the belief that the large companies, the large tech companies can benefit from this, whereas smaller companies really may not be able to and will become irrelevant because they don't have the money to invest in what is needed to be invested in this. And that's what you're seeing here. People are mega short the Russell and mega long the NASDAQ. This does not happen very much, I can tell you. But that's where we're at right now. So that tells me, well, it doesn't tell me which way is the market going. Just because the NASDAQ thing is saying what the NASDAQ thing is saying doesn't mean the market's going to go down. But what it's telling me is if I'm looking to be on the long side, maybe this Russell stuff is really the better risk reward place to be at this point, right? So maybe instead of playing the same old NASDAQ names at this point that are going to take advantage of AI, let's look for other stuff that is not in the NASDAQ, right? And you can see that since that's happened the last few weeks, the Russell really has outperformed the NASDAQ over that time period.
Yeah, I'm going to go ahead and pull up the Russell right now, and you know, certainly if we kind of go back, this has been a lot of false starts, a lot of like, you know, oh yeah, I'm gonna go, and then it doesn't. It like lasts 2 weeks and then rolls over. But certainly, recently the Russell 2000 has gotten back above its 200-day moving average line, back above 2200, and today, I mean, we were basically looking at a breakout on the technical side out of a short little area here. Have you seen anything on the news side that kind of gets you thinking of the news failure, or are you still waiting for that?
Not really. Not really, but I can tell you that the Russell's outperformed the NASDAQ just in the last 48 hours by about 200 basis points.
Does that count as a news failure event in itself with
It
growth coming in and this doing well?
It doesn't really to me, but all it really means to me is if you're looking to play on the long side, I think that the Russell offers the best risk reward. And if you're looking to play on the short side, then the Nasdaq is probably the place to be doing it.
Okay, very good. Well, let's talk about some stocks. Now, you typically. Oh, I had one more question on the futures part. You know, when you're looking at all of the different futures that are available, I mean, you've got wheat, you've got cocoa, you've got sugar, you've got the currencies, you've got all of these different things that you can look at in the futures market. And I feel like it would be a little bit hard to necessarily be an expert on all of those, to say, okay, what is the news failure event? But I guess on the other hand, you don't really have to be looking at all of them at the same time. The COT really kind of tells you where to put your focus. But how closely do you have to watch all of these different futures markets to take advantage of these opportunities?
I mean, for me, like you say, it's the ones that are showing the most crowded that are the ones I really need to pay close attention to. So there's not, at any one time, there aren't dozens of markets that are showing maximum crowded. There's maybe a handful at most. So those are the ones I'm paying attention to. I always look at it, I say, like I'm counting cards on the blackjack table, right? There's 37 markets that I trade, futures markets that I trade. So I'm essentially counting cards in the 37 markets. And when the count gets high, then that's where I'm going to play, right? So it's really not that hard to figure out, what's been driving this market or that market. You know what I mean? It's pretty simple. You don't have to do all 37 markets all the time. But when things start to get crowded, it's pretty easy to sit there over the weekend and say, well, what's been driving the copper market recently? What's been driving the wheat market recently?
Right.
It's not that difficult.
So kind of looking at a few of individual stocks, one area that you shared with me, again, for your real job, right? For what you're doing with institutions and your clients, the money that you manage for others, is one strategy. But in your personal account, you might do a little bit more on the stock side. And I assume you kind of still bring in a little bit of that contrarian approach. But right now you seem to be gravitating towards a lot of AI adjacent, maybe you could call them, because it's those stocks that are certainly part of the AI revolution, but not necessarily the direct AI. It's more, the power grid, the cooler, making
No,
cooler
I
heads.
I think it's fascinating, and that is where I have put quite a bit of my personal portfolio of stocks. We're seeing that the Nasdaq futures are getting way too crowded relative to the other indices, right? So I want to try to avoid those names at this point, from a risk-adjusted sort of perspective.
And I suppose that would especially be your large mega cap $1 trillion companies, because that's what.
Which I have not had a problem with for this entire time. There are plenty of videos of me on YouTube that people can see where I'm like, look, man, I wouldn't short these things. You got to be crazy. This is where you got to be, right? The whole way up, if you remember when NVIDIA first took off, sort of in early 2023, people were trying to short that thing the whole way. And I made a number of videos going, you're crazy, okay? You're crazy, because you're all saying it, right? But now that the Nasdaq has gotten to that point, which again doesn't mean the Nasdaq's going down, it just indicates to me the risk reward is better somewhere else. So where else is it? Well, if the AI story is what's driving all this, which we could probably argue it's a big part of it, right? We know what the problem is, right? Which is, where's all this power coming from? So if they have to build out all this power, then that's going to be a lot of money going there, and that's some good wind at your back for those type of investments, right? And I just think it's kind of funny because, for the most part, utilities and all that have not been a growth story for 60 years. I mean, William O'Neill was not buying utility companies. You know what I mean? And rightly so. They were dividend plays, and that's what they were, But now that's shifting, and I have a hard time believing that people are mega overcrowded long those type of stocks, right?
Yeah.
Because it's been so long since anybody cared about any of those, right? Call your friends and neighbors and ask them what stocks they own, and I'm sure they'll tell you Nvidia, Apple, Tesla, whatever, the whole gamut of what everybody likes to play. None of them are going to be utility stocks, right? And now we're getting this big shift here. And I think it's very interesting. And forgetting about what I say, look at what the market's saying, right? I mean, I look at some of these stocks, PWR, ABB, GEV, TLN, VST. These stocks are they're all breaking out.
Yeah. And not just a little bit. I mean,
No, a
look,
lot.
GE Vernova, of course, just had earnings. That was up 14.5% today. I do have a position in this myself.
Good.
But yeah, that does not look. I mean, this is not quite a utility, but when we were talking about how much GE when it was all together was a laggard, ever since it broke apart into GE Aerospace, GE Vernova, and GE Healthcare, I mean, it's really unlocked a lot of value from that company, it seems like. And GE Vernova has certainly been, since the spinoff, really at the forefront. I mean, look at that. Here's where the spinoff happened last year at 120, and now we're up at 630. So
Yeah, I just why not be in an industry where the wind is at your back? You know what I mean? I can make up for a lot of mistakes.
yeah,
And clearly that's where this industry is at this point. I don't see, and again, I can't see the future, but it seems to be a very hard argument to make that this is going to go away anytime soon because they're building these humongous data centers. Something's going to have to power them.
right.
And we know that even besides that, this is a question of national defense as well, right? And that never seems to have any kind of limit. National defense does not have a limit, right? So somewhere down the road, money is going into this, and they're going to have to build this grid to be a lot bigger. And I understand nuclear, and that's some other plays. They're a little bit more speculative, but certainly Oklo has done very well, which was a stock that we've been talking about for a while here. But the nuclear thing is probably a number of years off still, obviously, right? Whereas these things are happening now. So
Right.
it's been surprising to me. I guess the weakness in natural gas recently has been a little bit surprising to me based on this. So I'm not in that because I don't fight the tape. I might have an idea. I might like it's just like the COT is an idea, right? I might have this fundamental idea here, and that's all wonderful. But if the tape ain't agreeing with me, then
Yeah.
I'm not doing it.
Yeah.
In this particular case with these stocks, the tape has been agreeing with that idea. So I've been
Yeah, it's kind of
involved.
like what we say a lot of times. You can have great fundamentals on a company. It's got these great earnings, it's got this, great sales, all of these things. But if the stock chart is showing you something in a downtrend, well, something's not right.
Don't be
Why do
silly.
you want to have any part of that? I don't care how great the company is.
No, that's
If
right. The market is the ultimate judge, right?
yeah,
So I like to wait until, like I say with the COT stuff, the COT might say one thing, that's the idea. The idea is everybody's too short. Great. But if the market keeps going down, then I'm not getting long, right? Until the market confirms. It's the same thing with this type of stuff. The idea is, okay, power generation. Great. And when the stocks are acting well, then go with it.
and
I just find that, I don't know. I could be completely wrong on it, but it just, I find it very fascinating, the fact that these are companies that nobody cared about for decades.
yeah. And Quanta Services PWR, I do have a position in this as well. But how do you kind of play that? I guess that do you bring any of that contrarianness to these, or news failure events, or how are you kind of managing your risk, getting that risk reward ratio right on the individual stocks when you don't have that
Yeah, it's a
COT?
little bit, different. It probably shouldn't be, but it's a little bit different. I just kind of say like, okay, here's my portfolio in my retirement account. You know what I mean?
Hmm.
I'll put, whatever, 3% into this name,
Hmm.
as long as it's acting well, you know,
Hmm.
meaning if it's not lagging the market, if it's not going down while all the stocks and that it's correlated to or are going up and it's going down, that's going to make me nervous, right? I don't trade these very actively, but I'll look at it over the weekend and say, how are these stocks that I am in doing relative to how they should be doing?
Right.
And if they're doing what they should be, then I'll just sit on them.
Hmm.
I don't see how you can be, and I'll top ticket with this line right here, but I just don't see how you can't have some portion of your investments in this industry
Hmm.
right now. If you don't, I just don't think you're paying attention
Right.
to what's going on. Could they top? There's a difference between the stock and the underlying business because the stock is a discounting mechanism. Could they have
Hmm.
already discounted all of this in? Sure, it could have. But given that it's on new all-time highs, it clearly hasn't just yet.
Yeah.
We get a news failure. Okay, now we can start
Hmm.
talking about, okay, maybe it's discounted in, right? But we haven't had anything like that yet. So I'll just sit there and try to ride them forever. And it's not to say the stocks are going to go up every day. They're not. You know what I mean?
Hmm.
But you want to get like these 10-bagger type of things. You got to sit. You got to sit. And
Hmm.
I'll just sit on them. And I believe in the theme, and as long as they're acting as they should, so to speak, um, I'll just sit in them.
Yeah. So last question, when do you know to get out? What tells you, oh, okay, you know, just like the COT going neutral tells you, okay, my edge is gone. What tells you that,
So,
oh,
for example, I own some XLU.
mm-hmm,
And there was some bullish news after the close last night on this utility sector.
mm-hmm,
And look what XLU did,
yeah,
right? It was up strongly during the day and it closed down on the day.
mm-hmm,
While these other ones were still ripping. PWR, ABB, all those stocks were ripping today. Why
mm-hmm,
did XLU go down? There was no reason. And the stock market was up, by the way.
right,
Why was
yeah,
XLU down today?
mm-hmm,
I don't know. So I sold it.
mm-hmm, yeah.
Because
Shoot first, ask questions later.
could it go up tomorrow? Sure. But to me, it didn't act how it should have been acting.
Mm-hmm.
So when something doesn't act the way that it should, that's when I get nervous. So I got out of my XLU today.
Yeah. No, really makes a lot of sense. So, Jason, I want to thank you again for coming on. I really love how you look at things. And again, the fact is, you're using data. You're using data of what's actually what traders are doing. Granted that data is publicly available, but the way that you put it all together makes it pretty easy to see. What's happening. And again, when do things get lopsided on the boat? And kind of tells you what side you want to be on. But you always, whether it's a stock or not, you're looking for that confirmation. You're looking for the confirmation. You don't just go by one thing. It's got to have both. So
I always say it to people, no matter what you do, I don't care if you do what I do. You shouldn't do what I do. You should do what you do. But no matter what you do, the market has to agree with you.
yeah,
Right? Fighting the tape is the worst thing you can do. Have an
yeah. Don't
idea.
think that
I
you're
don't care. I
smarter.
don't care what your idea is.
Yeah,
Have an idea. It's
hmm,
great. Research it. Great. You believe in it. Great. But until the market is agreeing with you, I wouldn't be too aggressive.
yeah. Totally makes sense. Well, again, thanks a lot, Jason Shapiro, Crowded Market Report. Where can people go to get more information? Of course, they can follow you on X at crowded underscore, what is it, MKT underscore RPT, or they can go to your website, right?
Crowdedmarketreport.com.
Hmm.
I don't do a lot on X, to tell you the truth. But you can go on YouTube. We do a lot on YouTube. A lot of free content on YouTube. You
Yes.
look up Crowded Market Report on YouTube, and there's all kinds of stuff there.
Yeah. No.
Or
Great.
just go to our website,
Yeah. Perfect.
crowdedmarketreport.com.
Yeah, your YouTube content is very good. I look at that on occasion, and yeah, I'm always impressed with, again, the things that you bring up are things that I wouldn't normally look at, but always fascinating to hear hear your take on them. So really appreciate you coming on the show.
Always good to talk to you, Justin.
Okay, take care. That's going to wrap it up for us this week. Thank you so much for joining us, and I hope you join us next week. We're going to have a brand new guest on, Bob Lang. He actually used to do our options content. He used to write an article for us. He, of course, has been in the business for quite a while. Associated with Jim Cramer. Not many people know this, but he's the one that actually came up with the FANG acronym. He is of explosiveoptions.net. He's also the author of a book. So we'll be going over some of his options content and ideas and technical analysis associated with options. So we hope you join us for that next week, live at 5 p.m. Eastern. Hope to see you there. Thanks a lot for watching this week. We'll see you next time. Bye now.